Oil just crossed a threshold that most people thought we'd never see again outside of a major war. And right now, the Middle East is closer to that line than it's been in years. Analysts aren't throwing around the number $200 a barrel lightly. They're running actual scenarios where that becomes reality. But here's the strange part. Gold, which has always been the thing you hide in when the world gets messy, just had its worst week in over 4 decades. Worse than after 9/11. Worse than the 2008 collapse. Worse than the initial shock of the Russia-Ukraine war. That disconnect is the real story. And if it doesn't bother you, you're probably about to make a very expensive mistake. Let me walk you through what's actually happening. I'm Felix, and I spent years inside investment banking before stepping away to teach regular investors how institutional money really thinks. What you're seeing right now isn't random market noise. It's a chain reaction, and once you see the links, it becomes almost predictable. Start with geography. 20% of all the oil that moves by sea passes through a single narrow strip of water called the Strait of Hormuz. It's only about 20 miles wide at its narrowest point. Iran sits right on top of it. And here's what most news segments won't tell you. Iran doesn't need to win a war to cause real damage. They don't even need to close the strait. They just need to make it dangerous enough that insurance becomes impossible. If a major insurer pulls coverage because a ship might get hit by a drone or an explosive-laden boat, the tankers stop moving. Not because the water is blocked, but because the math no longer works. And markets don't wait for the actual closure. They price in the risk immediately. That's why Brent crude is already moving the way it is. We've seen this pattern before. In 1979, during the Iranian Revolution, oil roughly doubled. In 1990, ahead of the Gulf War, it doubled again. When Russia invaded Ukraine, oil ran to nearly $140. So $200 isn't a conspiracy theory. It's well within the historical range when a major producing region becomes unstable. But the price of oil itself isn't really the question you should be focused on. The question is what happens to everything else on the way there. Oil isn't just gasoline. It's embedded in almost every part of the modern economy. Every truck, every cargo ship, every passenger plane. It's in fertilizers, which means it's in your food. It's in plastics, pharmaceuticals, cold storage, commercial heating and cooling. When oil goes up, the cost of moving, making, and storing almost everything goes up, not eventually, immediately. And that brings us to the Federal Reserve. For most of last year, the market was convinced the Fed would be cutting rates in 2026. That was the entire bull case for stocks. But higher oil means higher inflation. And higher inflation means the Fed can't cut. In fact, several Fed presidents are now signaling zero cuts this year. And some on Wall Street, including JP Morgan, are starting to talk about the possibility of a hike in 2027. That is a complete reversal of the story everyone had priced in, so the Fed is trapped. If they lower rates, inflation accelerates because energy is already pushing prices up. If they hold steady, the economy slows under the weight of expensive money. And if they raise rates, markets get hit hard. There is no good option. And it's not just the US. The European Central Bank is saying the same thing. Higher energy costs could force them to keep rates higher for longer. What was supposed to be a year of relief is turning into another year of pressure. Now, let's connect this back to your portfolio. Higher oil leads to higher inflation, which leads to the Fed not cutting, which means effectively higher rates than the market expected. Higher rates make borrowing more expensive. And that matters because a huge amount of recent investment, especially in things like AI data centers, is funded by debt. Hundreds of billions of dollars. Every percentage point increase in interest rates adds billions in additional interest costs for those projects. Lower profits mean lower stock prices, and that chain reaction doesn't stop there. A stronger US dollar tends to follow when the Fed stays tight, and a stronger dollar is historically bad for gold. So the same conflict that's pushing oil higher is also, through this mechanism, pushing gold lower. That's the counterintuitive insight. War breaks out, oil spikes, and gold crashes. It only seems strange until you walk through the dominoes. So why did gold just have its worst week in decades? Because a few things happened at once. The dollar strengthened, which makes gold more expensive for foreign buyers. Gulf states, which are normally major gold buyers, have been selling to offset falling oil revenues or manage capital flight. At the same time, leveraged gold ETFs, the ones that promise 2 or 3 times the daily return, started getting hit. When gold drops 2%, a 3 times leveraged fund drops 6% in a single day. That triggers margin calls. Margin calls force selling. Selling pushes the price down further, and that creates another round of margin calls. What carried retail investors up the mountain becomes the wrecking ball on the way down. But here's where the data gets interesting. Institutions appear to be buying this dip. Not the leveraged paper products, but physical gold and well-structured exposure. The selling we're seeing right now is largely mechanical, not strategic. And that's a very different signal. If you're an individual investor, the question isn't whether to panic. The question is, which parts of the market are built to handle this environment and which are not? Energy companies are an obvious place to look, but I'm more interested in the infrastructure around energy. Pipelines, storage, service companies that get paid whether oil is at $60 or $160. I call them toll collectors. They don't need prices to keep rising, they just need the flow to continue. Defense is another sector, but you have to be careful. A lot of the good news is already priced in. What I prefer are companies with genuine pricing power, businesses that provide something you can't easily live without, even if they raise prices 20%. Large tech and parts of healthcare fit that description, and some of them have been beaten down enough to become interesting again. On the other side, I would stay away from airlines. The economics of that business are brutal under the best conditions, and high fuel costs make it much worse. Retail consumer spending is under pressure. Banks are rate sensitive, which is not where you want to be when rates stay high. And utilities, which some people treat as a safe haven, have a real problem. They can't usually raise prices without government approval, which means their margins get squeezed when inflation runs hot. The bigger point is this: we are moving from the initial panic phase, where everything sells off and volatility spikes, into a second phase where money starts to flow toward the actual winners. That transition is where most of the long-term wealth is either made or lost. And it doesn't require you to predict the outcome of the war or the exact path of oil prices. It just requires you to follow the chain reaction. Higher oil leads to higher inflation. Higher inflation leads to a tighter Fed. A tighter Fed leads to a stronger dollar and higher borrowing costs. And those two things determine which sectors get crushed and which ones get carried. If your time horizon is long enough, gold still makes sense. Not as a short-term trade, but as a hedge against the very thing we're watching unfold. But you have to hold it the right way. Leveraged ETFs will destroy you in a volatile market. Physical metal or well-structured, unleveraged exposure is a different conversation. Every crisis creates a split. Some people lose a lot of wealth, and other people gain a lot of wealth. The difference isn't desire. Almost everyone wants to be wealthier. The difference is skill. And skill, in this context, means understanding the mechanism. Not the headlines, not the fear, just the dominoes. So take a step back. Look at your own portfolio. How much energy exposure do you actually have? How many rate-sensitive stocks are you holding? Real estate, high-growth tech, utilities, all of those get punished when rates stay higher for longer. And then ask yourself a different question. If oil stays above $100 for the next 12 months, which businesses get stronger and which ones get weaker? That one question, answered honestly, will do more for your returns than any stock tip or hot take ever will. The market is going to be fine over the long run. But the path between here and there is going to separate people who understand the chain reaction from people who don't. Make sure you're on the right side of that line.